Okay, good morning, everyone, and welcome to our Tuesday Market Outlook session. So today, I will be walking you through how we are viewing the current market. And we saw a strong recovery in equities last week after a strong pullback. And, all in all, the major indices are still respecting their respective support and resistance areas. So while the recovery last week is definitely encouraging, as key support areas were not broken, price action yesterday does point to a slightly more neutral sentiment as resistance levels seem to be holding for now. So, as usual, quite a lot to get through today. And quick disclaimer, the types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, as usual, we'll be starting off with the major indices, highlighting some key levels, going over some technicals to get a better idea of market direction. We have seen a big drop in volatility last week, which was a plus for equities, but volatility still hasn't declined to the levels that it was at before the recent sell-off. And that highlights that there is still some risk to be concerned about. So it's always a good idea to know where the key levels are and the possibilities of, where price should price decline further, where it will decline to. Now, from there, we'll be moving on to fixed income and commodities, where we are starting to see more consolidation after significant volatility in recent weeks. We'll be taking a look at the sector rotational model. We have some very interesting rotation that is happening over the last week or so, and I think it's something that you should all be aware of, especially all this rotation that we're seeing towards the defensive sectors. We'll be taking a look at just the one subsector of interest that I have for you today, and we'll be ending today's session with some bullish and bearish market observations. My name is Prakash Vijayanath. I am an analyst here at Options Play, and today I am really excited to share with you our thoughts and analysis on the current market, and we will be starting with the S&P 500. As you can see here, clearly respecting its support and resistance levels, right? We have this strong uptrend from 428, broke above that. Sorry, my lines are not working. Let's see. There we go. Apologies for that. So we have we saw the S&P 500 find support at 428. Strong rally, broke above that 453 level with strong momentum and rallied all the way to 470, where it initially ran into some resistance and ran into resistance again at that same level here. So it was already proving to be a significant resistance level, and we did see a bit of that sell-off, see price decline all the way back to that 453 level. Initially breaking below it, but quickly recovered, maintained above it, and last week we did see that very quick bounce higher all the way back to that 470 level once again. But yesterday, we saw a rejection of that level once again, and it looks like price is set to move lower opening today, the last time I checked. So what does this point to? For me, it points to the fact that right now, it's looking like there might be a bit more consolidation ahead here for the S&P 500. Overall, yes, we are on a bullish trend. You only need to look at the weekly chart to see that. But I think it's fair to say here that there is some uncertainty regarding the new variant, and that has reduced this very bullish outlook that we have had heading into the new year. So I do expect more consolidation between these two levels at 470 and 453. What would be concerning would be a break below 453 here, but I don't really see that happening just yet. It seems like markets have taken a bit of a breather and are not doing a knee-jerk reaction to the new variant and are just waiting for the research to come out for now. So taking a look at the NASDAQ 100, again, we can see here that it is respecting the key levels. We are seeing rotation out of technology, which we will get into in a few minutes, but that is putting a lot more pressure here on the NASDAQ 100. So a strong rally here all the way from 453 all the way to 400. Where it ran into resistance similar to the S&P 500, and then we did see that pullback all the way to the 382 previous swing high level. Price actually breached that level twice in 2 days and broke above that level. and maintained above that level, I should say, and again bounced higher all the way to 400, where once again ran into resistance, looking like it's going to be opening lower here. So definitely a possibility for it to revisit that 382 level over the next few days. But overall, the NASDAQ 100 is underperforming the S&P at the moment, and that is because it is more exposed to the higher growth names. And that leads me to my next slide here, which is growth versus value. And for me, this really expresses the theme in markets right now. And that is rotation out of growth and into value. Rotation out of the higher beta tech and maybe discretionary names and into the sectors like utilities, staples, and healthcare that provide more defense when there is uncertainty in markets. So if we take a look at the chart itself, we can see here that there was an initial breakout for growth relative to value a few weeks ago. But since then, that really hasn't been able to maintain, and we have seen this choppiness between growth and value, this constant tug of war between growth and value, and we are seeing value here starting to gain some momentum relative to growth. And that being said, yes, growth is still elevated relative to value, especially if you take a look at the weekly chart here. But we are seeing more choppy action, and we are definitely seeing evidence of the momentum in growth fading away. So I do think, I mentioned this a month ago, I mentioned it last week as well, that this chart, value versus growth, very important for heading into 2022. Taking a look at small caps. So small caps have definitely been on the more volatile side compared to the large cap names. But what is vital is that they are maintaining above that key 213 support level here. And should that level break to the downside, it's really hard to see where the next area of support is. I think the next obvious key area here would be that 170 pre-pandemic level that we can see. And I really do doubt that, should there be a break below, that price would decline all the way there. But at the same time, you don't know where price will head should it decline further, should it break below the 213 level. So it is a very vital support area here. That being said, overall, price has pulled back to this long-term range, which is concerning, despite that initial break above the 233 resistance level all the way to 245. Initially, we saw that as very constructive, but the fact that it's all the way back down at 215 or so, it really has changed our sentiment here for small caps. And if you consider the fact that we are kind of shifting to that risk-off sentiment, it doesn't really bode well here for small caps. And I do expect small caps to underperform the large cap names for the next couple of weeks or so. So taking a look at the VIX, we saw this strong decline here over the last few days for the VIX after that initial knee-jerk reaction due to the new variant. So I'm not sure my lines aren't working. I apologize. So yeah, apologies for that. We saw that knee-jerk reaction for the VIX, strong spike over 2 weeks, all the way to around 30 or so, and then we have seen a strong decline, which coincides with the fact that equities were rallying last week. That being said, we are not really at high enough levels to be concerned about equities as a whole, but we are not at levels that we want to be at, which is around 15, 16, maybe even 18 or so, which was where the VIX was at for the last few months, last few weeks, last few months, and before that sell-off here. So, in my opinion, this again re-emphasizes the shift to the risk-off sentiment and rotation out of growth into value, where we will see major indices being more choppy. But there will still be opportunities in value and defensive names, as opposed to when the VIX essentially spikes, all the way to around 30 or so, or there's a strong spike up, and we do see that more systemic sell-off. Taking a look at bonds, interesting price action. We saw that break above that 151 resistance level. Let's see, I apologize again. I just don't know why it's not working. But we saw this break above that 151 resistance level all the way to 155, and a strong rejection from that level back below 151. Price did decline all the way to around the area between the 21-day and 55-day exponential moving average. It bounced higher to 151 yesterday, but looks set to open lower here, and again provides more evidence of that 151 level being a significant area of resistance. Overall, I have emphasized the fact that I am a bit more bearish on bonds, and I do expect price to decline to 146, even if it's a little bit choppy. And should that level break, 141 would be the next area to look at. But right now, the initial target would be 146 here for TLT. Taking a look at the US dollar index, we have to remember there's a more hawkish Fed right now. They do not view inflation as transitory, they view it as permanent. And that increases the probability for additional rate hikes more than what the markets have priced in. Should that be the case, the dollar becomes more attractive and you will see the dollar continue its rally. But what we have seen here is a very bullish case for the dollar. Right, ever since price declined back to the 93.5 level, broke above the 93.5 level and retested it. Price did move higher with very strong momentum all the way to 97. It did pull back to around the 95.5 level again. And, I mentioned last week, we should expect some consolidation with the dollar, and that certainly has been the case because of this such a strong uptrend that, was a little bit overbought initially. And we are seeing that consolidation right now. But what is important here is the 95.5 level and the fact that that level is holding right now. Should that level break, you may see a move back lower to 94.50 or so. But as long as this level holds, overall the outlook for me would be bullish on the dollar, especially when you consider, one, the fundamentals, but also the fact that the currencies that the dollar is compared to, the euro, the yen, the major trading partners for the US, they aren't really in a position to increase rates. So I do think that this bodes well for the US dollar in the long term. And I do think that there is a further rally ahead after this consolidation. Gold. So gold generally moves inversely to the dollar. And we have seen that break below that 167 level and a bit of a pullback, a bit of a retracement. But not with a lot of momentum, not a lot of momentum at all. And that does point to the fact that this isn't really reversal in price, but more of a retracement, lacking momentum. And I do think it's only a matter of time before we see a further downside here for gold. Although, due to the fact that the dollar is fairly choppy right now, I wouldn't be surprised to see the price action for gold to be choppy as well. But in terms of downside targets, I'll be taking a look at that 165 area. And should that level break, I'd be looking at around 161 or so, which did provide some support and form a double bottom a few months ago. So crude. Crude is an interesting one, a bit of a roller coaster, really, if you take a look at the price action. After pulling back to that 62 level, we saw this very strong rally all the way to around 84 and a very strong reversal back down to around 62. Price did bounce high from that level with strong momentum and has since consolidated at around this 21-day exponential moving average, kind of struggling to break above that, but price hasn't reversed lower here. And I do think from a technical perspective and price action perspective, this does point to more upside here for crude, back to maybe around 75. That being said, the macro picture plays a very important role in this. And, oil is going to be very, very exposed to the fact that governments may enact more lockdowns or more restrictions, which is going to impact the price for crude. So that is something to be made aware of here. Taking a look at some sectors, last week we had 6 sectors with bullish trends. This week we have 7, slight improvements. But overall, we still have weakness in communications, financials as well, just not being able to perform that well. Energy as well, staying neutral, but a bit of an improvement in industrials. But taking a look at the sector rotation, you see 7 sectors in the improving and leading category, 4 sectors in the leading and lagging and weakening category. A bit of an improvement again from last week. But what I want you guys to focus on is the sectors in the leading category, the defensive sectors in the leading category, I should say. Utilities, healthcare, staples. These are all defensive sectors where you can see there's been strong rotation into due to the fact that markets are a little bit more spooked right now. There is a bit more uncertainty, and they are providing leadership. Real estate is in here as well, although I would consider that more because real estate does provide a bit of an inflation hedge. Again, another major theme in markets. So fairly broad leadership overall if you look at the overall picture compared to just having technology or discretionary in the leading category, which has been the theme for the last couple of months. But that leadership is restricted within those defensive sectors as rotation out of cyclicals into defensive is the theme. Taking a look at some of the weak sectors to pretty much avoid, communications has been weak and lagging for a relatively long time, and discretionary strong rotation out of that weakening category all the way to the lagging category. Not great momentum, not great relative strength here. So this was a concern for me, a few weeks ago when the new variant was detected, that discretionary, especially with this time at the festive period, it was just bad timing for the sector. And I'm not surprised to see it lagging relative to the overall market. So taking a look at technology as our first sector. Now, the reason I wanted to highlight the sector was due to the strong bifurcation we are seeing within the sector. Since the pandemic lows, technology was the sector that had the best outperformance by far. And this has had a really positive impact on the sector as a whole. But now we are seeing divergence in performance between the stable tech names and the highly valued, unprofitable, maybe more speculative names that are being punished right now. This again points to the risk-off sentiment we are seeing in markets. And you have to remember, traditionally, technology is not a defensive sector, but the stability in the individual names within that sector is definitely, I would say, attractive for investors here. And you can see, even just on Friday, that technology did post a new all-time high. Actually, even yesterday, kind of went a little bit higher before pulling back, and it is set to open up lower this morning. But overall, the technicals look quite positive here for technology. Strong bullish trend on the weekly chart, strong breakout of 159, 160 area, and again, another bullish leg up, and a bit of a pullback here. In terms of areas to look at, I'll be looking around 164 as a minor support area where price did bounce off twice in the last few weeks, and should that level break, maybe 159 or so for technology. So overall, still bullish, but I wouldn't depend on the sector as a whole. Rather, I'll be looking at some of the individual names, the companies that are more stable, that are profitable, and maybe not as highly valued. Taking a look at healthcare. So healthcare is one of the defensive sectors that I did mention in the sector rotation slide, where we did see strong momentum rotating into healthcare. And we can see that in the price section here. First, price is making higher lows, as we can see. So the definition of a bullish trend in many ways. That being said, if you take a look at the tops of those trends, there was some confusion here where we were expecting to see healthcare continue its rally all the way to 137. It just didn't have the steam. It just didn't have the momentum. And it did pull back all the way to around 129, found some support. And again, moving higher with strong momentum, already breaking above that previous swing high. I do think this is very constructive for that move to 137, especially when you see the momentum that it's having now. That's not surprising, but should it break above this level, I do expect a continuation high here for healthcare. And utilities as well. So I would say similar enough price action to an extent, higher lows here for utilities. But the key level, and a key level that I was stressing needed to be broken, was at 67.9, 68 level, and price did break above that level last week. I did mention utilities again last week, and the fact that I was expecting some consolidation here for utilities, maybe a pullback back to that level and before a move higher. We did see some consolidation, but that was not for very long. Yesterday, price moved higher with strong momentum, and already it's near those pre-pandemic levels, I should say, at around 70, almost approaching 71 here. So positive picture here for utilities, and hopefully can finally break above those pre-pandemic that pre-pandemic high at around just below 71. So taking a look at JETS, which is the global, the US airline, US global airline ETF, we can see a bit of a big downtrend, right? We could see that price did pull back all the way from the 29 level, found support at around 22, and has been fairly range bound for a few months now. And there was initial breakouts that only went as high as 25, bit of a double top there. Price did decline with strong bearish momentum, and then the new variant was really the catalyst for that break below the 22 level with strong bearish momentum. Since then, price did retrace all the way back to that previous support level, which is now turning out to be a resistance level. Rejected that fairly strongly, and we are seeing strong bearish price action here. I expect that to continue. And in terms of levels to look out for, I'd probably be looking at around this 18 level, so 1850. So not a very volatile ETF by any stretch of the means, but definitely more downside here when you look at the chart. So taking a look at some market observations here, our first bullish market observation is CRE Group, which is part of the real estate sector. And as mentioned before, real estate sector very strong at the moment. We are seeing a fairly decent risk to reward opportunity here for CBRE, where it did pull back from all-time highs at around 107.50 all the way to around 95, where it found support and bounced higher with strong momentum. Price has consolidated over the last few days, but has not broken below the 21-day exponential moving average. And I do think this provides some evidence of continuation of the rally back to 107.50 and maybe even further higher here. But again, it's part of a strong, very strong sector, and I do think there is more upside here for CBRE. Next, we have American Waterworks. American Waterworks, part of the utility sector, and I really like the price action here. We saw this, this strong rally ever since it broke above 150, all the way to around 188. Since then, price did reverse lower. It formed a base here at around 168 or so. Bit of a bottoming formation, but it did remain range bound between 168 and 176. And that being said, we did see a strong breakout here above the 176 level with good momentum. And I do think that provides evidence of that move higher here for American Waterworks back to around 188, which was its previous all-time high a few months ago. And again, good momentum, pretty good price action, a break above a fairly important resistance level. It does point to more upside here for a name in the utilities sector, which is a very strong sector at the moment. Next, we have Eaton. Eaton is a bit of a play on the reshoring of manufacturing, especially in the US, where the pandemic caused a lot of supply side disruption, and companies are now looking to invest more in reshoring their manufacturing to avoid pandemic level threats where the supply side is that badly impacted. And if we take a look at Eaton from a price action perspective, we can see the strong move from 148, where it did find support after a significant pullback, all the way to around 176. Just below that, where it ran into resistance. It did sell off along with the overall market in recent weeks. Since then, bounced higher, back above its 21-day exponential moving average, and definitely looking like it's finding support at that area, bouncing higher from that 21-day exponential moving average a few times now. So I do think this points to further upside here for Eaton. And again, looking at the fundamentals, I think there's a very strong case here for a further rally here for US manufacturing and this name in particular. Taking a look at some bearish market observation. First, General Electric. So GE, pretty much a year-long range between 100 and 113. It did form a bit of a triple top there. As you can see, price rejected that level on 3 occasions and moved lower with a strong bearish momentum. On the last occasion, the new variant did provide that catalyst for a break below that $100 support level. It declined all the way to around 92, found some support, and pulled back to its 21-day exponential moving average. Bearish price action at that level and a strong move lower here. For me, almost a textbook pattern there where you see this break below support, a bit of a retracement, and then a strong move lower. And you really need to look at the weekly chart to gain a better idea of what the downside targets would be. And the first one there would be 85. I do think that if you look at the weekly chart, price action is fairly bearish here. We saw this strong bearish move, a bit of a pullback there last week, and again, it just looks to be continuing lower here. And again, first target there would be 85, around 85 or 86 or so. So next we have Disney. Disney, it's from a fundamental perspective, like they have made an effort to diversify, and for the large part that has been successful, but for the pandemic it really hasn't, and that's because even though they have launched a new subscription service, Disney Plus, it hasn't been growing at the rate that they need it to be for it to really provide support for the other operations that just aren't doing too well at the moment. And we can see that here where price did find support initially at around 168, fairly range bound for a few months, strong break below that level due to earnings, and a bit of a pullback here back to its 21-day exponential moving average, looking set to open lower again today. And I do think that bearish price action here provides a good entry point for a further move lower here for Disney, back to maybe 142. And should that level break, I'd really be looking at around that 135 to 140 area here on the weekly time frame that you can see price did find some support in the past. The last bearish observation I have for you today is Cooper Software. So this is one of the names that that really reflects my view on the fact that we are seeing a bifurcation in the technology sector. We have some names that are very, that are providing a bit more value. These are companies that are profitable in the technology space. And then you have these companies that are very exciting, highly valued, but just do not provide enough defense, are just maybe overvalued and are not profitable. So we are seeing that rotation out there, and that's clearly evident, especially in the last few weeks. We are seeing a strong break below the 210 support level, and prices continuing lower with strong bearish momentum. There was an initial retest at 180 that has failed on 2 occasions there. It's difficult to see due to the volume lines, but from a risk reward perspective, I would prefer if there was a retracement back to 180 or so. But overall, the downside targets here would be 126, and bearish momentum is fairly strong. So we have to wait and see if we get the retracement or not. But should there be a retracement, I do think it provides an excellent risk reward entry for a move lower from that 180 level, maybe all the way down to 126 over the next few weeks or couple of months. So with that, I'd like to end off with a bit of a summary. The 3 points that we should be taking away from this session for me is: 1, there is more evidence of a risk-off sentiment in markets. 2, rotation out of growth and into value. And 3, defensive leadership in utilities, staples, real estate, and healthcare. With that, that is all I have for you today. Thank you so much for joining me during the session, and I hope you gained some insight as to how we are viewing the current markets. I hope you have a great trading day ahead.